Welcome to Fintech Confidential, bringing you the people, tech, and companies that change how you pay and get paid.
We are living today in a historical time in that 96% of U.S. households have access to a bank account. So I can tell you without question, consumers use more than 2 email addresses in 30 days. Their risk profile goes up exponentially. A landline is the riskiest phone type that any consumer can currently apply with. The emergence of the neobanks and the digital banks further complicates the matter. To overlook ACH would be to be overlooking the dominant payment type in the marketplace today. The way that traditional credit scores are delivered is virtually the exact same as it was 40 years ago. What we are finding is most consumers aren't comfortable providing that level of access. I believe over the course of the next 5 years, we are going to see a consumer empowerment era. Consumers are going to have increased control over what they share and with whom they share it. And as a result of that, there will be a leveling of the playing field in terms of financial institutions. Open banking isn't necessarily the panacea that some people perceive it to be. We took 2 payments companies and put them together, which gave us a lot of experience with a broad set of banks. 71% of consumers want to be active in the process for a fairer credit scenario. We want to be part of that process.
Support provided by Skyflow. What if you could build fast but not break privacy? What if you could ensure data privacy, governance, and compliance with just a few API calls? What if you could worry less about PCI requirements while actually improving privacy and security? How much more time would your team have to truly innovate? How much faster could you build and ship new features? How much more powerful could your app be? Skyflow is a zero-trust data privacy vault delivered as an API. Skyflow's radically simple design lets you collect, secure, and tokenize personal information like card data and payment details. And with built-in features like encrypted data analysis and sharing, anonymization, and advanced governance, your days of choosing between data security and data usability are over. Whether you're just concerned with PCI compliance or need to go further to include CCPA, GDPR, SOC 2, and beyond, Skyflow has you covered. What if you could build fast but not break privacy? With Skyflow, you can. Visit skyflowsecure.com today to learn how. Welcome to Fintech Confidential's Leaders One-on-One series, where we bring you face-to-face with people shaping the future of fintech. I'm your host, Ted Huff, and together we'll explore the latest trends, challenges, and success stories in fintech. Each episode, we feature in-depth conversations with industry leaders who share their experiences, insights, and strategies for navigating the ever-evolving landscape of fintech. Whether you're a seasoned professional or just starting out, you'll find valuable takeaways to help you stay ahead of this dynamic field. So let's go ahead and get started. I'm super thrilled to introduce you to John Gordon, the CEO of Validify. Now, John has one heck of an impressive background in fintech. And honestly, he and I both started before it was even called fintech. And it's been over 25 years that we've both been doing this. And he's held positions at companies like TransUnion, Online Resources, Premier Global Services, and Derivian Metavante. At Validify, which he joined as president in February 2022, he's been focused on providing predictive bank account and payment intelligence. Now, this company is dedicated to helping organizations validate bank accounts, detect fraud, and assess credit risk through unique applications of data. And in this episode, we're going to cover the current challenges in fintech, including fraud prevention and compliance with regulations, how Validify addresses these challenges with their advanced solutions, the role of alternative data in enhancing credit risk assessment and improving financial inclusion, insights on open banking and its impact on customer choice, and emerging trends in fintech that are shaping how we will be moving forward in the future. So I hope you'll join us as we explore these topics with John Gordon from Validify and gain valuable insights into evolving landscape of fintech. John, welcome to Fintech Confidential.
Thanks, Ted. I appreciate you letting me be here.
There are some exciting connections, as we were talking about while we were preparing, between Fintech Confidential and some of the partners you have over there at Validify. Companies such as Best Eggs COO Alex Rhodes has been on, and Tim Lee, the founder of Lend API, has also been on. It has been extremely fascinating to me how Validify has supported these organizations, and I'm really excited to dive deeper into these stories as we talk about them more today.
Yeah, I appreciate that. I saw both of those gentlemen on here in the not too distant past, and it was great to see both a partner and a client spend some time with you, and I'm glad to be able to do that today.
I would be remiss if I didn't start off with a leadership question first. You've been in financial services for over 2.5 decades, just like me, and even before it was called Fintech. What would you say is the biggest lesson you have learned, and how?
Boy, I tell you, I think part of this, Ted, is you're pointing out that we're both seasoned. I liked that choice of words that you had. I think the thing that I have learned is that things change, often beyond and outside of your control. And the critical aspect of it is to stay true to your purpose and the team that you have around you. And as I think back to Operation Choke Point, when we were at Factor Trust, where we lost more than 50% of our revenue in a week, or back to your point, back to Derivion in the late 90s when the dot-com bubble burst and the impact that it had to all of us, we had to realize that we just had to stay the course and stay true to what we were doing to have the chance to continue on and to take a breath, survey the landscape, and not react in a reflexive action, but to take the time to really assess what happens and see where you go from there.
Let's fast forward a little bit, right? You've seen a lot. You've been part of this a while. How have you seen ACH transaction evolve, and how are you seeing companies manage the risks that are associated with that evolution?
So ACH transactions, it's almost like they are the constant, the standard, and they continue to grow above and beyond what I think most people realize. And now with the emergence of real-time payments and pay by bank, there are opportunities within this legacy payment type that are emerging, that are offering people new and expanded benefits in utilizing this trusted ACH solution. An example of that for us is our partnership with PDI, and they support the attachment of payment capabilities into loyalty cards for convenience stores. The important aspect of that is the validation of those accounts and the ability to attach the consumer to the account. That is an exciting opportunity for consumers to have more payment options, for service providers like the convenience stores to support more payment types that potentially offer an opportunity for them to lower their transaction processing costs.
I was looking at the recent report on ACH transaction risks that Validify put out, and one of the things that caught my eye is that high-risk accounts experience 11.5 times more ACH returns to a lower risk account. And only 14% of those payments really ever become successful. Can you help us understand the challenges that you've seen in spotting those high risk indicators, whether it be ahead of time or during the transaction?
We are living today in a historical time in that 96% of U.S. households have access to a bank account. And according to the FDIC, that is the highest rate we've ever experienced. And we would attribute a lot of that to COVID and the wise move by banks to make online account opening easier for consumers. But there's offshoot of that too. And it created a lot of velocity, a lot of change in those consumer account connections. And what we found, to your point, is that oftentimes when a consumer struggles with their bank account, or a bank account is a legacy account, or in the instance that it's fraud, it's the same accounts again and again who are having these return challenges. But not all ACH returns are created equally. Some of these returns are what we call fatal returns, in which scenario the person who is trying to collect the funds has no recourse. NSF is a reality for all payments via ACH, and they kind of come and go. But what we find is a consumer who has an ACH account, if it's an NSF in the first scenario, it's oftentimes going to be an NSF in the second scenario as well.
One of the things that I'd love to get your perspective on, I was wondering, how do these virtual DDAs impact the risk profiles? I remember back in the days when I would work with prepaid companies on the credit card side of the house, and we did a virtual DDA on those accounts. And then I've worked with a lot of banking as a service providers and helping them get through the next stage for themselves. And they're using virtual DDAs. And then I have software companies that I'm helping that are building out an entire suite of services, and they're using virtual DDAs. I would love to understand how the use of these virtual DDAs, let me see if I can say it one more time. How that's impacting the way that Validify is managing scores and determining the risks.
A lot of this, any sort of DDA, and I'm not sure you're directly referring to, but the emergence of the neobanks and the digital banks further complicates the matter. I think at the outset of any account where it's difficult to attribute a connection between the consumer and the account, whether it be payment history or any sort of time continuum where you can connect that consumer with that account over the course of time, creates uncertainty. And the longer a consumer's had an account and the more you can attribute positive payments to that account, the less risk there is in the payment process. So what we have seen specifically in the case of the neobanks is that oftentimes service providers are staying away from the neobanks because they don't have maturity or experience with those accounts. And frankly, they have become in some cases difficult as consumers are using them in a somewhat transient fashion. We see oftentimes that some of our lending clients are telling us we have an applicant apply with a more traditional account only to want to change that account into a neobank account later in the process. And they are guarding against those things or trying to guard against those things. But now we're having people tell us we want to be able to differentiate between a virtual DDA user, a neobank account user, so that we can assign some sort of performance aspect, because as they grow in popularity, so too does the opportunity for someone to do business with those folks who are utilizing those accounts in the right way.
One of the really cool things about Validify is the whole value proposition behind it is really to mitigate the fraud, like you were talking about, from lenders, from service providers, from these types of risks. How does fraud impact the customer acquisition and the risk mitigation tactics that your clients are using today?
In today's day and age, there are a lot of folks, whether it's buy now, pay later, or lenders who are funding the entire principal at the point of acquisition, who are front loading a lot of the risk. When we have accounts, whether it's first party fraud, which is a prevalent scenario in any transaction where you have the merchandise as the consumer, or you have the full principal amount as the consumer, where the inability to debit that account later or some change in that account later materially harms the product, and it ends up resulting in an increase in the cost of credit across the board.
Can you give us an example of one of those scenarios that most people would understand?
Sure. So we work with a personal loan lender. They fund you the entire principal via ACH. So if you at the time of application as a consumer list a bank account that you can access for the purpose of getting those funds, but then you terminate that relationship through a stop payment or any sort of termination via the bank, you have created a scenario where you now have the funds and the lender has no recourse to go back against those accounts. It's a form of fraud. Lenders are seeing that it's oftentimes the same combinations of routing numbers and direct deposit accounts where these things are happening in a lot of velocity in a short period of time. These fraudsters will set these things up. They sort of interact with them oftentimes through lead aggregation partners where they go and apply with someone other than the lender, and those leads are shopped. They fund the loans and the consumer's gone. That looks an awful lot like a first-party fraud scenario where the consumer opts not to repay. But we have found that a consumer who utilizes a direct deposit account in concert with an identity, oftentimes they will make a number of payments and then they start enacting stop payment scenarios in rapid succession. Or they're changing things that are ancillary to the PII. Ancillary isn't the right word. It's more the other contact element. So I can tell you without question, a consumer who's used more than 2 email addresses in 30 days, their risk profile goes up exponentially. If we have a direct deposit account that we've seen greater than 5 consumers with, it's going to be problematic.
I wouldn't have thought of the same DDA for multiple consumers. Like that is not something that just sits at top of mind for me.
It seems obvious, Ted, but we did a recent study for a lender where greater than 10% of their population, the consumers, we could connect to greater than 20 accounts. And then we like to look at it both from the consumer to the account and then the account to all of the disparate number of consumers we've seen with those accounts. And then we're validating the phone number, the email address, not just from the standpoint of have we seen it with that consumer, but who's the carrier of the phone number? What type of phone is it? And for you and I, again, back to the fact that we're dating ourselves, a landline is the riskiest phone type that any consumer can currently apply with.
The most common cause of bad customer experience isn't that high tech. It's embarrassingly simple. Yep, it's answering questions. In e-commerce, it's really easy to get bogged down with common questions, whether that's where's my package, how do I return or exchange this item, or just to cancel a subscription. Solvpath is an AI-driven customer support system that enhances the customer experience with visual formats and self-serve technology to empower your customers to handle their own support requests. Get the best customer support system for your business. Get Solvpath. Get started by visiting getsolvpath.com. That sounds so counterintuitive.
It
You would
does
think
to me.
Landline would establish security. A mobile phone would be the least secure, and somewhere in the middle, a voice over IP might land.
I agree with you, but that's not the case. And if you had told me that 5 years ago, I would have thought you were insane. But the reality today is you'd rather do business with a prepaid cell phone than you would somebody applying with a landline, statistically speaking.
Crazy. Help us understand, like, what are the reasons you're finding that's causing that?
We have the benefit of 1 billion inquiries that we've seen. So across that, our data science team will look at the frequency of change with all of those different pieces. Specifically, why a landline? I would ascribe a lot of that to the fact that there just aren't many landlines still in service. And the ability to quantify, I can give you more data on a cell phone because that data has become more normalized and available than what I can give you on a landline. And potentially I can utilize a landline without the ability to validate beyond the fact that it is indeed a landline. I can't tell you as many recent metrics about the attachment to the consumer, the frequency of payments that are being made.
Oh, it's riskier because you have less information about it.
100%.
And
The ability to quantify.
the more information you have about that identifier, that phone number, gives you the ability to feel more confident and comfortable with the person requesting the information or the person being validated. So that actually does make a lot of sense. I remember whenever a mobile number would come through on an application, whether it be for merchant services, a loan, an account opening, it having to be manually reviewed.
100%. I think back to the fact that everybody I knew who had a landline was my parents or the people that I went to high school with, and you kept them forever, seemingly. Yeah. The frequency of change with cell phones these days, they're almost disposable in some scenarios.
I want you to walk us through a specific client outcome that was achieved with Validify's tools. And I would love if you could share their name, but if you can't, I understand.
Well, I can. And it's my personal favorite at the moment. It's PDI Technologies. I mentioned them a little bit ago. They attach pay-by-bank capabilities onto loyalty cards. So think about if you're at your local convenience store and they're going to give you certain incentives.
I'm starting to wonder, like I'm in Phoenix, Arizona. Circle K is based here. And I'm wondering, there might be a connection with their Easy Pay.
There just might be. So what we do in that scenario, and it's one of my favorite applications for this express reason. If you're a consumer who wants to enroll in that convenience store's pay-by-bank capability, when you go to enroll in that process, the consumer has the option of selecting whether or not they'd like to log into their bank account. There are so many advantages to service providers, lenders, for consumers who log into their bank account. You get account ownership. You get 90 days worth of transactions in some scenarios. You get a verifiable account and routing number combination. All of those things are very beneficial. But what we are finding is most consumers aren't comfortable providing that level of access. So we offer them an option where they can list their account and routing number. From that standpoint, or from that point in time, Validify will then, based on the risk profile of that consumer in the account and the depth of information that we have, offer the opportunity to either validate that account from a fraud perspective, to conduct an OFAC check, whatever it is that PDI needs for each individual consumer to get them enrolled, increase their acceptance in the program, and enable that payment instrument. We're able to help them to maximize the opportunity to get those consumers enrolled in the process and having the option to pay by bank.
I can only imagine that this has a much broader impact on reducing the financial risks as well as the ongoing customer relationships. What have you seen from your clients that have done these sorts of things to verify and validate ahead of time using your technology?
We have seen clients in general, they struggle with the amount of friction that they want to inject in any onboarding or payment addition process. They want to ensure as much safety in the process and security in the process as they are able, while limiting the friction of what they're asking their consumers to do. We call that managed friction. So there's some scenarios where you absolutely want to inject some friction in the process before you make a $10,000 payment to Ted Huff to ensure that he is in fact Ted Huff. There's other instances where you want to make the process as simple as possible to keep going so that you don't have an abandonment scenario and people ultimately don't walk away.
Well, I will take that $10,000 deposit without any issues. Just let me know how I get it all set up. You talked about looking at risk scores and looking at all this information. I'd love to understand how you are seeing the impact of AI, machine learning, when it's used in data analytics, and most importantly, on how it's helping provide actionable insights for your clients?
At the risk of being controversial with my former industry mates in the traditional credit scoring world, I'll say it this way. The way that traditional credit scores are delivered is virtually the exact same as it was 40 years ago. The way that consumers acquire credit is so dramatically different than it was 40 years ago. The amount and availability of data and the willingness of the consumers to share information for what they consider a better experience is vastly different. And when you compound that by the fact that we're now in a world where buy now, pay later transactions, although hugely adopted, doesn't reside in traditional credit scoring or does in differing degrees. Medical debt, the medical debt still exists, but you can't see it in a traditional credit file, is making it really difficult for service providers and lenders to navigate. So the emergence of AI, alternative credit data's availability, and the ability to use it in generating analytical models that predict things, and the consumer coming alongside that, and to an extent, being willing to participate in that process is a sea change as people try and put consumers in the best product for their situation, minimizing risk. Against all of that, in the background is savvy fraudsters who are relentless in their ability to find ways, loopholes, different ways to impact all of these things and find ways to skirt the systems so that even your best laid plans, oftentimes there are holes in your defenses.
I've recently had a lot of conversations with companies that are looking to solve the authentication of individuals, especially with all the new technology that's come out, and looking beyond pictures, video, photo, voice. Like there's so many different things. But I want to understand what you're seeing with all of the behavioral analytics and all the different things that you all are doing over at Validify. You mentioned the underwriting, but what about the operational side of the house? How is it helping there?
We are squarely focused on account validation and the ability to cover as many accounts as we can. We recently announced a collaboration with JP Morgan Chase that will give us the ability to utilize their data in concert with our own data to help people on the financial operations side make better decisions based on a consumer, the account that they're providing in an onboarding phase about how do we drive the treatment strategy? Are we going to be able to trust this payment? Can we extend service to this consumer? Can we extend credit or make access to credit easier for that consumer? So all of those things work together. Part of what you're talking about is fraud. And for us, we don't consider ourselves a fraud solutions provider because fraud is so big. What we do is identify where we see potential fraud in concert with the consumer and their bank account and the PII that they're utilizing in a transactional basis to say, lot of frequency of change here. We've seen that account, and allow for our clients to determine based on, am I just onboarding this consumer? Am I taking a payment from this consumer? Am I extending credit? How they want to adjust accordingly.
You're getting additional data sets from JPM, and it is super important to leverage the most robust data sets you possibly can so you can provide those actionable outcomes based upon the rules that are set. I'm starting to think it's less about finding the fraud and more about finding the good stuff. How much more good stuff can you find, even when it looks bad? What do you think about that?
I think that is well said. I might take it one step further and say, how when I recognize that something is good, do I fast track that consumer or that relationship into being a valuable client so that I'm not injecting universal friction that is off-putting to someone who's potentially shopping for services? So how am I, based on the inputs that I have, making the best decision I can make and then treating each of those consumers independently? And what you've said about the JP Morgan Chase data is right on the money. Coverage wins. The ability to have material coverage, not just of the top 25 banks, but across the board, so that you're covering the long tail of credit unions and independent community banks. And the people who elect to bank in those types of scenarios aren't paying a penalty based on a service provider's inability to quantify those accounts.
Well, you and I talked about this previous to us recording. Service providers that are out there today, a lot of them, unbeknownst to a lot of people, really are, the way they're covering the long tail is through lower level partnerships, not like a JP Morgan, but lower level partnerships, or they're doing screen scrape style things to get the information. They're impersonating users, like all of these things that should, to a consumer, if they knew, be a very risky proposition for them to work with that group. What that also makes me think of is, if I'm one of those organizations that's leveraging that tool, it has to cause additional challenges in integrations and my operational workflows and all these different things. And I can say firsthand, I've had the benefit, I don't know if I would call it benefit, but the opportunity to learn how each one of these solutions doesn't fit the bill a lot of times. Can you help us understand, obviously JP Morgan, but what are some of the other ways that you're helping remove the challenges of integrating external technologies to make these workflows so that my dev team doesn't have to create a whole stack for each separate integration? Now let's quickly shine a spotlight on a game changer in the financial world, Clearingworks. Simplify your financial management with a one-stop solution for all your AR needs and with a single login. Are you intrigued? Visit clearingworks.com to schedule your demo today.
I think the example you just gave, if I were to group them, I would say that's exception handling. And I think that people, in essence, would be shocked at how many bank statements, paycheck statements are still being faxed or scanned and emailed as part of an application process, simply because we are unable to quantify the consumer bank relationship. And so the way that Validify helps with that is we took two payments companies and put them together, which gave us a lot of experience with a broad set of banks, an even larger set of consumers, where we've been able to watch those consumer relationships, see how they change over the course of time, see what the trusted payment accounts are, and be able to help our clients say, that's a stable account with a person that we've seen over the course of time. The total number of people accessing that account is within the bounds of what you would expect. Go forward with that consumer. And so from a dev standpoint, anything I can automate improves the experience of the consumer. So simply by decreasing the total number of people that belong in that exception queue, I'm driving down the cost of doing business and improving the likelihood that the consumer's ultimately going to take the service that I provide and utilize it.
You've got someone like myself who has multiple bank accounts.
Okay.
At multiple financial institutions, but none of them see the full picture of Ted Huff. The closest thing to anybody that has a full picture of Ted Huff is probably American Express.
Fair. I was going to say Mrs. Huff, but
we'll leave her out of it for today. But
that's a great point. So I was doing some reading on a recent study that said 77% of Americans have access to a credit card. 23% of Americans completely do not. How those consumers manage their credit card debt obligations is very different. Some people use it like a revolving line of credit that they max up, sometimes pay down. Some people are operating at fully leveraged capacities 100% of the time. So I agree with you. From a spending and a recurring habit standpoint, it's huge. But I think part of that has been based upon the fact that paying in a card not present scenario via ACH hasn't been as available as it will be going forward. I had somebody tell me not long ago that there was an analysis done that the cost of a pizza paid for with a credit card by a consumer who doesn't fully pay off their debt on a cyclical basis can end up averaging $100 for the pizza. So if I'm a consumer, if I have the ability to pay by bank and it's as I intend, one pizza, one time, I enjoy it, I've paid for it, it's over. Does that potentially change my behavior?
That is a discussion that I've had with many of my friends that are on the board of the Faster Payments Council. We talk about this a lot. Ease of use currently isn't there for your daily spend categories, like pizza would fall into, coffee would fall into, heck, even paying your accountant for the quarterlies. He said, hey, the fastest way to pay me is using Venmo.
Interesting.
And I was like, all right, well, that's really cool, but it doesn't integrate into the accounting software you asked me to use. So we're going to use ACH. Between he and I going back and forth to get everything lined up properly, it took us about a week to make sure that everything was right.
I totally agree with you that the diversity of payment instruments, payment avenues that is currently in the market today is greater than it's ever been. But I would say this to you at the end of the day. When you look year over year, ACH payments continues to grow. They grow in volume, regardless of sector, whether it's person to person, bill pay, any category that you want to select, ACH payments grow in number and value. And I think that in and of itself says that while Venmo, Zelle, all of these different payments scenarios will continue to grow and thrive, and I think that they will, to overlook ACH would be to be overlooking the dominant payment type in the marketplace today.
My friend Kevin Olson, the payments professor, calls ACH the royal king and emperor of payments here in the US. And a lot of people don't realize it. Venmo, Cash App, PayPal, Zelle, a lot of times use ACH in the background.
That's right.
When the ledger gets transferred outside of their walls, you'd be amazed at how often they use ACH. Now that we've decided to jump into the App Store, what I want to do is, there's one thing I need to get before I ask this question. I want you to look into the fun crystal ball.
All right.
Let's look ahead about 5 years and help us understand, what do you see happening for fintechs, financial institutions, when it comes to digital payments, fraud prevention, and validation?
I believe over the course of the next 5 years, we are going to see a consumer empowerment era come to pass in the United States that may not look like what a lot of the open banking proponents think it will look like. But consumers are going to have increased control over what they share and with whom they share it. And as a result of that, there will be a leveling of the playing field in terms of financial institutions. That isn't to say that the big banks won't continue to be the big banks. But I think this era of consumer choice is going to give those consumers a normalization of their ability to share their data where they want it to go for the purpose they want it to go. The flip side of that coin, if I'm a service provider, a lender, or a biller, is that open banking isn't necessarily the panacea that some people perceive it to be, because now each consumer is going to have some ability to show you the account that they want you to see versus giving you the comprehensive picture that will allow you to make a better decision. So the CFPB had set out this line of demarcation that is ability to repay. I'm afraid in the near term, we're making it harder to determine, outside looking into a consumer's presented information, what they can truly afford. And so sometimes we have this consumer empowerment before it has to balance back out so that the service providers have the ability to ask for enough information to truly deduce what consumers can afford. And so product selection is going to be critically important, but there again, more and more difficult to get to.
What is Validify doing to prepare for that?
At Validify, we view ourselves as being in the facts business. We are all for consumer inclusion, and we want to make consumer choice the driving factor in these things. But at the end of the day, we are also going to provide our clients with the facts about each consumer and their volatility. Sometimes when we hear financial inclusion, it's a different way of saying that we're going to overlook certain scenarios about a consumer to include them in the process. There was a study done, it was a Harris Interactive poll that said 71% of consumers want to be active in the process for a fairer credit scenario. We want to be part of that process. More consumers in the United States today have a bank account than have an active credit file. We're not suggesting we would replace traditional credit, but we do think we can augment it. But we will tell the truth about consumers, about how frequently they change, about scenarios wherein they've instructed their banks not to pay off payments that they dutifully signed up for.
All of this has been really, really good. Like, I love the fact that we dove into the different scenarios, why it's important to verify, how the verifications are happening, how it's going to impact the way that the parties outside that are either giving these forms of authentication or being able to offer loans or access to additional nouveau payment rails that are able to really figure out what their risk level is. But before we go, I do want to ask you one last question. If I am a fintech founder and I'm looking to solve a problem that requires me to verify and validate the bank account and the consumer, and you could only give me one piece of advice to use going forward, what would it be? Why? And in only one sentence.
Connections matter. Assess that consumer based on all of the information that they give you and the stability of each of those elements working together.
Why is that important? I mean, it goes without saying, but I would love for you to share why you feel that's so important.
Frequency of change, access based on how many different people are accessing an account, and none of these things can be looked at individually. So 10 years ago, when we talked about identity verification, we were trying to confirm that a consumer was in fact who they said they were. I think over the course of the last decade, we've realized that consumer identity has a lot of different parts. It has the email address, the property address, the bank account, all of the different pieces that they utilize and the frequency with which they change. Assessing all of them holistically will give you insights and the ability to determine who that consumer is more accurately than looking at any of them independently. You have to look at the big picture.
You do not disappoint, John. I do want to say thank you again for hopping on today. This discussion has been insightful. It's really helped us to understand how organizations are looking at these data points, why it's so important to get it right, how Validify is helping solve the issues of identifying the accounts and verifying the transactions and making sure that everybody gets paid what they're supposed to. At least that's how I'm looking at it. I really appreciate you going through that. And I love how you're looking forward to the future with all the new regulatory environment that's coming up, as well as the technology. You're not leaving any stone unturned. So I really appreciate you doing that today.
Ted, thanks for having me. It's been a lot of fun.
Well, folks, that does it for another episode of FinTech Confidential's Leaders One-on-One series. If you've made it this far, go ahead, share, like, subscribe, all that fun stuff. And if you want to find out when the next episode gets released, go ahead and head over to fintechconfidential.com and sign up to be notified. And as always, keep moving forward. As we wrap up today's episode, I've got one last thing for you. If you're in the trenches fighting fraud and financial crime, you know it's a complex battlefield. That's where Hawk's AI tools for real-time payment screening, AML, transaction monitoring, and dynamic customer risk rating come into play. These aren't just buzzwords. They're game changers designed to make your compliance more effective and less of a headache. Imagine slashing through false positives with precision and giving your compliance strategy the edge it needs. Head on over to gethawkai.com to sign up for a demo and discover how their platform can revolutionize how you fight fraud and financial crime.
This has been a production of DD3 Media, with all rights reserved. This is provided for informational purposes only. It is not offered or intended to be used as legal, tax, investment, financial, or other advice. We strive to provide accurate and up-to-date information, but will not be responsible for any missing facts or inaccurate information. You comply and understand that you should use any of this information at your own risk. Cryptocurrencies are highly volatile financial assets, so research and make your own financial decisions.